Welcome to the Three Edge Week in Review for the week of December 12th. I'm Fritz, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will discuss this past week's meeting of the Federal Reserve's Federal Open Market Committee. And at the meeting, the Fed raised short-term interest rates by another 50 basis points, or 0.5%. And this actually broke a string of 4 consecutive 75 basis point increases over the past 4 FOMC meetings. And we'll discuss both what the Fed did by raising short-term interest rates, as well as what Fed Chair Powell said during his prepared remarks and his press conference following the meeting. And most importantly, we'll discuss what all of this may mean for the outlook for the global capital markets as we head into 2023 in just over 2 weeks' time. So, Steve, let's first look at what the Fed did this past week, raising short-term rates by 50 basis points, less than 75, right? But, that's still a material increase. And so perhaps just to begin, could you just shed some light on whether, is it significant that they went 50 and not 75? And then maybe go a bit beyond that and just put in perspective what they've done through, really through 2022, which is pretty remarkable. So I will turn things over to you.
So Fritz, just to give some historical perspective, most all of the Fed rate hikes over history have been in 25 basis point increments or 0.25%. So anything beyond that is really quite unusual and special. So the fact that they were at 75 basis points and then went to 50, it's still much more than a typical rate hike. So I don't think that's so important. In fact, I would say that the consecutive 75 basis point rate hikes, or 0.75% rate hikes one after the other, is more a reflection of just how far behind the Fed was in admitting that they had an inflation problem. So I think it's more of that. And what I will say is that so far this year, the increase in Fed rate hikes has been one of the steepest we've seen since the 1970s. But again, to add some perspective, it's from a very low base. So we were at near 0%.
Right.
And now we're in the 4.25 to 4.5 range. So that gives some perspective.
All right. So now let's turn to what Fed Chair Powell said, both in his prepared remarks and during the press conference after the meeting. And as many people in our business do, we'll see, did Fed Chair Powell provide any clues as to the future direction of monetary policy as we turn the calendar into 2023? And I have to say, I listened to the news conference, certainly seemed to me as though Powell was pretty explicit that the Fed has a way to go in terms of increasing rates, and that they see borrowing costs will be higher than they had expected earlier this year and higher than investors expect next year. And so, it's kind of interesting because this year it's like investors have this narrative of, well, they're going to stop relatively soon and they're going to have to decrease rates in 2023. So my question for you is, could you read the tea leaves here and tell us, why is there a difference between what the Fed is saying and what the markets are hearing?
So I really believe that Chair Powell and the Fed is looking to reestablish their credibility in a major way after underestimating the initial inflationary surge so badly. So they're desperate to get back their credibility.
Right.
Also, I know Chair Powell often talks about historical perspective himself, and he points to the 1970s, and he correctly points out that they thought inflation was starting to come down. The Fed eased up on all the monetary tightening. In fact, they started to loosen. Inflation did come down, but not quite as low as they hoped. And then it went back up again to all-time new highs. And everyone has looked back at that period and really criticized the Fed at that time for taking their eye off the ball too quick, for declaring victory on inflation too quickly. And Chair Powell doesn't want that to be his legacy, that he couldn't learn that lesson. So he'd rather err on the other side and make sure he wins the war against inflation than be criticized for making the same mistakes as what happened in the 1970s. Now, as far as the market goes, you're absolutely right. Investors have been acting and investing as though they know better, and they think that the Fed is bluffing, and they think that despite what the Fed says, they're going to have to stop raising rates very soon, and they're going to start to drop them. And so I think that's why we've had this big rally leading up to this meeting, and they were expecting the Fed already to show signs of capitulation, and they were not accommodated. The Fed talked tough. They had a very consistent message, and they said, and like you said, in very explicit terms, they're going to keep raising rates for some time.
All right, I'm going to take a trivia flyer here. Was it Arthur Burns who was the chair of the
Yes.
Fed in the 70s? Yeah. No one wants to be the next Arthur Burns.
That's right. You get some bonus points for that.
All right. Well, here we go. Third question, which is always my third question in these videos, is okay. So based on what we've discussed about monetary policy and the Fed rate increases thus far in 2022, and what they did last week, how should investors be thinking about their portfolios as we turn the page and go into 2023?
So I think what's been happening lately is really critical. We've been talking about a moment of truth. And we've been talking about how bear markets have certain patterns that repeat. And one of the patterns that repeats time and over again is the fact that during the bear market, the S&P 500 index lives below the 200-day moving average. And we have these strong bear market rallies, or we might call them hope rallies, where investors hope that the bear market is over. They hope we break through. And some Wall Street analysts have been already calling that, saying that we're in a new bull market.
Right.
And so we're right on the verge of breaking that 200-day moving average when Chair Powell had his remarks this past Wednesday.
Yeah.
And we once again, we repeatedly hit that 200, and then we fell back shortly after. So our base case in our models would support this, certainly, that we remain in a bear market until proven otherwise. And that, in fact, of the three-phase bear market, we're just entering phase two. And that's when investors begin to become more aware and recognize, oh, it's not just about price action going up and down. Corporate profits are actually now on the verge of entering a phase where they're going to weaken. And we could very easily see in Q1 of next year, corporate earnings announcements coming out either worse than expected, or the guidance that the companies give is for weaker earnings in the future. So our base case is we're still in a bear market. Could have a ways to go in the absence of any surprises, and that one should stay cautious with U.S. growth stocks that are represented in the S&P 500 index. That is by all the indices we look at, that's the most overvalued index. The fact that the yield curve is even more inverted now is a sign of that it's likely that the economy will slow further, and that will make it even more difficult for profitability to stay so strong. So that could also lead to weakening profitability. And then psychologically, when an index keeps running against resistance and it can't break through and then it falters, that's usually a very negative psychology signal to the shorter term traders. So for all those reasons, we remain cautious on U.S. stocks, especially the S&P 500 index. I would say there's relatively less downside potential on non-U.S. stocks because they never got as overvalued as the U.S. stocks. We would be cautious on corporate bonds, especially high yield or lower quality bonds, because the economy does slow further, and it's likely to slow further, and credit spreads will stop tightening and start to widen again, and that won't be good for corporate bonds.
Right.
Longer term, we're bullish on real assets like commodities and gold because there's been a short supply of commodities, and gold will really take off at some point when the Fed finally is forced to stop hiking rates, and maybe at some point they capitulate. But as long as they keep raising rates, there'll be a short-term headwind against real assets. And so the assets that make most sense now are ones we're heavily invested in, which are short duration treasuries, which are now earning, since this last move, will be earning more than 4%. And then TIPS, so Treasury Inflation Protected Securities, which unlike a year ago, now earn a positive real yield over and above inflation. So depending on the maturity, they earn, between 1% and 2% over and above CPI. And CPI now, even though it came down, it's still 7%.
Right.
And so that's a good deal. So that's where we would focus.
Excellent. Great. Well, Steve, thank you very much for your insight into this. It's important because certainly doesn't seem as though the focus on the Fed and its impact on both the economy and the markets is going to be going away anytime soon. So thank you for that. A brief housekeeping note today. Our 3 Edge video today will be our last video for this year. Over the coming weeks, we'll run into the holiday calendar. So with the holiday calendar as it is, this will be our final video for 2022. So want to take a moment, send a heartfelt thank you to all our listeners and all of our clients for the confidence that you've placed in our firm. We take that responsibility very seriously. And so on behalf of Steve and everyone here at 3Edge, we want to send all the very best wishes for a happy and a safe holiday season, all the very best for the coming year. And thanks for listening. We'll see you again in January.